All right, session number 8. We are going to try to knock out as fast as we can, try to get through some of this terminology stuff. Not that I want to just rush for rush sake, but I want us to, understand what's going on, have some working knowledge, and just recognize that you'll probably ask again, which is why we make the videos and have the content that you can go back and reference and go, what was that again? But the point is again, it's got its own verbiage, and you don't want to be sitting in front of a client going, I don't know what that is, but we'll figure it out. So we design this so that you have some working knowledge to understand when somebody speaks, you can understand the language. It's kind of like if I go to Mexico and they're speaking in the language, I'm going to be confused and probably starve or maybe die because I don't know how to get it. So we got all the way to K1, certificate of good standing, payoff, UCC sponsorship, secondary source. I think we got all the way to secondary source. So we didn't do secondary source of repayment, but we did par.
Yeah, I think we left out on par.
That's all right. Okay. So secondary source of repayment, what is it? What is the whole concept behind the secondary source of repayment?
It's like a form of collateral or like your own personal cash flow that is kind of a backup if your primary source of payment ends up failing.
Yeah, exactly. The lender, and I would say most of the times the banks do this, okay? Life cos, CMBS, private money, pension, they don't really look at this, but banks always look at what they consider a secondary source of repayment. Now that can be a liquidation of the asset. That could be, just their own cash flow they have as a backup, could be cash. They're just trying to say, well, okay, if the primary doesn't work and the cash flow we're underwritten on the business goes plop, what are we going to do as a backup plan? And what does that look like? Do you have nothing? And so they're always going to press into that secondary source of repayment. A lot of times that'll tie in with global cash flow, where they'll do the primary cash flow of the business needs to service the debt 1.2 times, but they'll also do a global, okay, if you have like 10 properties, they'll do this whole global thing to say, well, in totality, do you debt service? Because if you guys remember, I talked about the concept of robbing Peter to pay Paul. So I had to pull from this property to pay this one. That could become dangerous. Does that make sense? So from an underwriting perspective, they want to make sure that they have a backstop and they've thought through those kinds of scenarios. If you're not telling by now, bankers are very risk averse. They don't like risk, and they're always looking at how to mitigate it. So questions about that secondary source? Okay. Discounted payoff. You guys know what a DPO, discounted payoff, is?
When the lender of the loan is willing to take a discount of the face amount.
Yeah, and what would be the reason why they would do that? Because you're like, why would somebody take a discount, for crying out loud?
Is it if like they think they're not going to repay it?
Yeah, it could be. Yeah. Yeah, you could be in a situation, this is probably going to happen in the next couple of months, where somebody just, they're like struggling, maybe they didn't meet their covenants anymore, because covenants are like in your loan documents. You say you'll maintain the certain cash flow, you'll have this kind of debt service coverage ratio. So all of a sudden they start falling out of the ratios, and they realize that, oh crap, I'm not going to be able to make my payments. And so the lender might finally say, well, okay, I could drag this on, and eventually maybe I have to take the whole thing back, and then that's going to be a mess, okay? Or I could incentivize the borrower to go out and just get us taken out. And I'll just take a little bit of a hit, maybe 10% or 15 and just go away, right? And they take a small lump now versus if I hang out with you, I might take a huge lump later. So I'll just rather take my lump now and not have to deal with it later. Does that make sense? So that's kind of conceptually when you get into weird markets, when things aren't working out. I've seen that many times where the lender just says, look, we'll take a DPO, pay us off, get rid of us. A lot of times back in 08, these companies were buying blocks of loans from banks, like hundreds of them, and they were buying them for like 15 cents on the dollar. So all of a sudden, if I'm the borrower, I just got a new lender who bought my loan for like 15 cents on the dollar. And then they come back to me and go, hey, I'll give you a DPO of 25%, because they're still going to make a tremendous amount of margin. And so they're like, cool, I'll get you taken out, and they think they just hit the jackpot, which to some degree they did. But the person that really made out was the guy that bought it for 15 cents on the dollar. Okay. So does that make sense?
Mm-hmm.
So
So
there's just, go ahead.
if that were to like happen, like how like directly does that affect like integrity capital? Like, are you losing money off of that, or
No, we're not, because we don't hold the
you're
paper.
not the lender? Yeah.
So what we do is we consult people through that, and we make fees and money to try to help people work stuff out. And we might even come in and buy stuff, and then kind of work with them to try to work it out. We're not predators. And so if we buy stuff for a discount, we're going to try to figure out some way to help them. Like, it'd still be beneficial for us, but, help everybody kind of win. So yeah, but it's definitely an area you don't see until things get rocky. But good to know. Just kind of, it just starts to form in your mind, like when things go haywire, where it's going like, okay, how do we make a deal work? And sometimes I've gone back to the lender and said, hey, I can't do this loan at this, but I could at this. If you guys are willing to take a hit, we can get you taken out. Sometimes they'll say, yeah. So just something to have in your tool chest.
So when they do the discount, is it they just set it up for the rest of the term, or can they do it for a certain time period and then go back to it when they can?
Well, are you talking about the lender that's taking the discount?
Yeah.
Well, if I'm taking the discount, let's just say, for example, my loan is $1 million, okay? And I'm servicing that. Okay, so I'm the lender. If I take a DPO of 10%, now that's $100,000. I'm going to get taken out. So someone's going to refinance me out of that loan at the 900,000, not the million. And so I'm going to eat 100 grand as a loss. Does that make sense?
Yeah.
You tracking with me on that?
Yeah.
Yeah, it could be a little tricky. Yeah, so when the DPO happens, what's happening in that transaction is I'm only going to give Zach a discounted payoff if he truly pays me off, because I want to get rid of the loan off my books. I don't want to hold on to it anymore. Okay. Nick, does that help?
Yeah.
Okay, good. Awesome. CNI. You guys remember what CNI is?
It's like a non-real estate related loan. So it's kind of to help a business with like particular needs that they may be, whether it's like buying an asset, working capital.
Correct. Yeah, you're going to hear this term. You'll be sitting in a meeting. I was in a meeting this morning with a bunch of lenders, and they said, they were like, we're CNI lenders, and if you don't understand, they're like, what the heck is that? So it's commercial and industrial. So what they're basically doing is they're doing lines of credit, they're doing accounts receivable. There's just things, again, that are non-real estate related, could be equipment. for the business. So we don't do a ton of C&I. It's just not an area we've focused on. It's a different animal, but there are times you might do it as sort of an adjunct piece to the loan, where it's like, well, we're going to do the real estate loan, but we'll do a C&I with it. Okay. You need a line of credit or equipment and so on and so forth. Something we are doing more of is called factoring. You guys ever heard of factoring before? So let's say that you and Zach have a business and you're making a bunch of money, but when you do a sale, you're not getting cash. So what happens is you have an accounts receivable to you from all these vendors. And you're like, well, this is great, but we actually need cash. I need to actually have money come in the door. So what'll happen is there's lenders who will come in and say, okay, Zach and Ben, we will pay you cash now, and we'll give you 85% of your accounts receivable. And then we're going to charge the interest, and we're going to make the difference. So when you get paid off, you're only getting 85 cents, but we'll give you the cash now. But to a lot of people, they go, well, that's fine with me because I need my cash and, whatever, so, and they'll do kind of a short-term deal.
So they'll charge an interest rate on top of that 15% that they're already making.
Well, it depends. I mean, they're probably just like they're discounting to get to the rate and yield that they need to. But what they're basically saying is like, when you get paid off, you get paid off the full thing. Let me clarify that. What they're doing is they're just saying, hey, we're only going to do 85% because if you don't collect all of it, then we don't want to be stuck with the back. We don't want to, we want to have enough cushion there where you could take us out. Does that make sense?
So they don't make that 15%. They just give you 85 of what you're owed and then make the interest rate off. Okay. I got you.
Yeah. And they charge probably 12 to 15%. Sometimes they could even get into the 20s. We've done a couple of those, and they're nice things because they close fast. There's not a whole lot to do, and it helps the client a lot. I mean, if they need cash, it's like, you're dead in the water if you don't have cash. I remember a guy when I was over in Idaho, Zach, and I walked into the meeting with him when I was over there. He's one of the largest contractors, and within 2 minutes, by the way, I didn't even know this guy. I mean, I just kind of walked in and he said, I'm screwed. And I'm like, okay, well, that's a nice way to start the meeting. And he just says, I'm totally out of cash. I have 8 projects. I don't know what I'm going to do. And, so on and so forth. So we had to kind of walk through a lot of, I had to sort of help him. I'm like, look, he's like, I need $1 million. And I said, no, that's not your problem. I said, you need a whole overhaul. Someone's got to come in, take all your debt out. You're going to lose all your equity, but you'll stay in business. Just, so it just helps people get cash. It's like, boom, give me cash. Okay. So there are those factoring things that you'll run into. And quite frankly, it'll happen more in the recession because the banks stop doing it. And then they need cash. Make sense?
Mm-hmm.
Okay. Any questions? And by the way, I want to be clear about something with you guys. If you don't understand the concept, don't pretend you do. Does that make sense? I mean, it just kind of toss ego out and, we're not in a jockeying position and it's just, I want you guys really to get out and go, yeah, that makes sense. I mean, I'm kind of a different type of learner. So, in fact, when I was in Idaho, this guy's trying to explain this kind of complicated tax, incremental bond thing to me. And He explained it 3 times. And I said, listen, I have no idea what you're talking about. I said, take out a piece of paper, write it out. And then he did. And then I was like, got it. Okay. Now I understand what you're talking about. Right. So just understand, I just want you to learn it. That's all. So make sense?
Yeah.
Okay. All right. Legal lending limit. What is it?
The max capacity a bank can lend to a borrower.
Yeah. There's there's 2 components to this. If I'm a $250 million bank, I'm small. That's a teeny tiny bank. Okay. You know, I have like this master lending limit. Okay. Where, you know, it doesn't matter. I just can't lend above this amount. And then I have the individual who I say, look, I can only lend you in totality to this one borrower, okay, 10 million bucks. So as soon as if you do 2 5 million loans with us, we're tapped. I can't do anything else with you. Okay. And so you can, and you go, well, how the heck do they get to that? And the response is, it's all based upon your size of deposits. So the more deposits you have and the size of the bank assets, the higher lending limit. And the reason why they do this, think about it logically. If I am, if I have this kind of portfolio of money, okay, let's say, because we're going to be lending money directly. Let's say I've got 50 million bucks to lend. It would be stupid of me to say, well, I'm going to lend 20 of it to one guy. Because if that one guy goes belly up, I'm in trouble. You know, that's just not a good situation. So they want you to kind of chop it up, diversify. It's kind of a fancy way of saying this is your lending limit. They're saying you can't throw your eggs in one basket. That happened in the RTC days in the 90s, and tons of banks just got hammered. Okay. So you need to be kind of spread out on your lending limit. So then the question is, well, gosh, then they're going to lose that client. And the answer is possibly, but they don't have to, because they can say, look, we'll take a little piece of it and then we'll participate the rest of it out to a bank who needs the loan. It'll still be us as the lead lender, and we'll kind of let them take the rest of the loan. So we're still sort of fostering the relationship with the borrower. Or sometimes they'll sell off a piece of the loan to another bank who might be flushed with cash and needs loans. So that is a potential too. We've done plenty of loans where the lender says, we'll do a participation. I'm not a huge fan of them myself, because you got 2 lenders, 2 underwriting to this. And if somebody screws up, it's like, we had one time we went all the way down to close. This lead lender was supposed to be managing this participation. And all of a sudden we get down to close, and the participating lender goes, I don't even know anything that's going on. And, you know, we can only do this. It's like, oh my gosh. So we would learn that we have to manage both of those situations. So it's just kind of a, you know, again, more hands in the pot, and it can get kind of wonky. So does that make sense?
Mhm.
Yeah.
Questions around that, or? Okay. Rate lock agreement. Rate lock agreement. You guys remember?
And just like, if you have like a loan, like it's not like an arm, like an adjustable rate. Like you're stuck to one rate at any time. Like it can't change based on like economic factors. So if you have like a rate before COVID, it would maintain while in COVID.
Yeah, no, yeah, good shot at it. It's actually what this actually means is if I there's a couple different things. So if let's say that you know Zach and Ben go in and they say, hey, Mr. Lender, we're buying this big investment property. You quoted us at, you know, the 5-year treasury plus 200 over. And one of the questions you're going to be asking yourself, if you're wise, is when are you going to lock the rate? Because it's going to take us 60 days to close. And things are going like this, right? And some lenders say, well, we'll lock now, we'll give you the commitment as long as we can close in 60 days. Some lenders will say, you could rate lock, we need a deposit from you. And if you walk away, then you lose your deposit. Okay. And then there's what used to happen in the CMBS world that does not anymore is they used to have forward lock agreements. So because if you guys remember on CMBS, it's this kind of secondary, you know, market that's tied to the bonds and rates can get volatile. Because they say, well, if the rates get wonky and all of a sudden I was paying this for it, I might no longer pay that for it because it's the market got wonky. And so now I'm having to pay more for it, which means it's more of a discount for the lender. Then what'll happen is they used to do these forward lock agreements for like 60 days, where if I was the borrower, I'd have to put up 2% of the deposit into the bank. So let's say the loan amount was 10 million bucks, then I would have to throw up, you know, 200 grand. Okay. And that money, so I get to lock my rate now, but it's only for 60 days. But if all of a sudden there's too much volatility in the market above a certain amount or below, that could break the lock and I could lose all that money. So it became at-risk money if it broke out of the hedge too much, okay? And so what they started finding out, this wasn't a good idea because all of a sudden it was like that would happen. And they're like, hey, dude, I'm sorry. And the borrower's pissed. They're like, are you kidding me? Like, I just lost 200 grand because the market went like this. So it doesn't really happen anymore in that sense. But there are lenders who will say, hey, we're, you know, if you want to do that, we're going to take a fee for it and you can lock now. So does that make sense?
So why weren't they able to get their 200 back? Like,
Yeah,
did the bank tank that and put that elsewhere, like within the bond market?
they
Like,
went out and bought a kind of a hedge. So they had to go out and buy like a swap or a interest rate hedge instrument to
Mhm.
hedge that risk that they had by locking the rate, right? They were kind of hedging their bets. And so they were like, well, we're going to buy this instrument to cover ourselves, but it only covers you up to a certain amount. So if all of a sudden it breaks over that, if the market goes above it,
It's
you
gone.
know, too much, then they're out of the money. You know, all of a sudden they're like, crap. You know, if we book this loan at this rate, we're losing money because it went above our swap, you know, that we were trying to hedge. So these instruments have certain things. It's kind of like, you know, if you're trying to buy a cap. And so you say, well, I'm going to pay, it's worth it to me to pay 200 grand, 300 grand, where if the interest rates, if I'm floating and the interest rates go up to here and it starts to go higher than that, well, I paid money for this instrument to kick in to stop it so that my rate still stays here, even though the market went up to here. Okay. So I'm willing to pay that money like an insurance premium, that if it goes there, then that would be well worth it. It may not go there. And, that's the cost of doing business. That's why you pay insurance, because it's kind of disaster relief. So the same thing happens for these guys. They have all these hedging instruments, but all of a sudden, if the market breaks out, right, and they just locked it at this, and all of a sudden the market's here, and the market's saying, hey, we're not going to pay you this for that loan because the market is here. So they're saying, we're going to give you a discount if you want us to eat that loan. So that's why they won't get it back. Does that make sense?
Yeah, I get that.
I think so, yeah.
And now, in all fairness, if the market just kind of goes boom and then boom during that window, you're probably okay. But if you run out of time, you're screwed.
So it can go over within that 60-day period, but if it goes back in, you're fine.
Yeah, because it's kind of
Okay. So it really just matters where you're at that 60-day point.
yeah, because you have this small window of time.
Yeah.
Kind of like when you buy an option contract. If you buy an option contract, you're like saying, I'll give you this money for this period of time for that price.
Okay.
As soon as that time's up, like, your option's gone if you didn't exercise it, right? So it's kind of this put, instrument that you have. So does that make sense? Hope I'm not confusing anybody.
Yeah, I was gonna say it sounds exactly like trading options.
It is. It's the same thing in a sense. All these instruments are just meant to hedge risk. That's what you're doing. Somebody's taking the risk. So if you buy the instrument from me, I'm saying, well, look, I'll absorb this risk, but if it goes outside of that, you're in trouble. But you can pay me money for me to eat that risk for you. Okay. So there's just always going to be some level of speculation going on in these instruments, right? I mean, if you kind of think about it from the CMBS side, they're kind of taking these risks that, the secondary market is going to want to buy this huge pool of loans for what they priced it at. It's a big bet, because that might not work out. And they're stuck with the bag of stuff they can't sell. Does that make sense?
Yeah.
So it gets kind of tricky. Interest rate index, what is that?
So is it like a general basket or kind of index that helps firms kind of see what interest rates they're going to charge?
Yeah, here's kind of all these different indexes. Okay.
So for LIBOR. Okay.
Yeah. So lenders well, what index are you going to use? Treasury, SOFR, swaps, so they just, LIBOR, prime.
Is LIBOR, are they getting rid of LIBOR?
Yeah, LIBOR's going away. I don't even know why
Yeah.
they still have
Yeah.
this stuff in there, but you've got prime. Look at that, 6.25 used to be 3.25. It's crazy. So, an index is just basically it's almost like synonymous for a cost of funds. So if I say to you, what's just my cost of doing business? And then I need to charge something on top of that so I can make a profit. Does that make sense?
Mm-hmm.
So, a lot of times banks, if they're large enough, they'll have their own internal index they use, because they just kind of calculate all their overhead expenses and employee expenses and, everything. And then they'll come back with some, nominal number that's like boiled down into an interest rate to say, our cost of funds are, basically 3%, with all of our infrastructure. And so then that's what we're going to use as our index. And then we're going to charge a premium to make profit. It's kind of like, I did this a while back. I was trying to figure out like what is my unit cost per loan file, like with all of the staff, and you have to almost get kind of nerdy and go cost accounting to figure out like what of your costs actually go into the loan and what costs aren't associated. Doesn't matter whether you're doing a loan or not, you still have to pay for it. Does that make sense? You're trying to figure out like what is that, those costs that are tied to the actual process of the loan. And then you try to come up with this kind of, unit price. We kind of figured out our cost was like $7,500 per loan. So we just said we can never charge below that number because we're technically losing money, and so people are always like, why are you charging so much? And I'm like, well, we don't make a profit if we're not above that. So it doesn't make any sense for us to do it. It's pointless. So that's kind of what they do. They have an index and then they'll charge a spread. Okay. That makes sense? Kind of a fun little website because you can actually see all these estimations of where they think the rates are going to be. They think that SOFR is going to get up to 4.5-ish in March of next year. So you're down at 3 right now. I think it's going to go all the way up to 4.5.
Is that just the yield curve?
Yep. So you're like, you can add, like you can look at the treasury. So like the 5-year. Interesting, isn't it? Like, look, it's inverted. If you look at the 7, the 5 and the 10, right? Look at this. 5-year is what? 3.78. 10-year, 3.62.
Does that just indicate a recession?
It does.
Yeah.
Yeah. Whenever you have this shorter term rates higher than that, that's usually the precursor for recession. That went on a little while back. Usually they figure 90 to 120 days is kind of the runway. But, kind of fun to look at these and how they estimate where they're going to be at. It's all these governors and things like that. Yield spread premium. Kind of goes back to par a little bit.
Yeah. So like the mortgage broker, it's kind of the interest rate premium that they make. So like if you have like your lender and your borrower, like they give you their par rate, and then the mortgage broker makes the premium in between the rate that they charge and then the bank's par rate.
Exactly. So there's this spread that is taking place, and they are, like for example, the general rule of thumb is if I want to start paying yield spread premium, it's usually 1/4 point in interest rate to pay somebody a point. So if all of a sudden my par rate is 5, if I'm the broker, I say, well, let's charge the client 5.25, and then you can pay me a point for every quarter that I jack it up. Does that make sense? And there's lots of lenders that do this, so
Wait, so who's paying you the point?
The lender is,
Okay.
the lender is. So the lender, again, and I say the lender, there are some lenders that don't, there's a lot of lenders that don't do this. And then there's some lenders who essentially do it. And that's all they do is they'll go and they will market to brokers and they'll just send them a kind of a matrix and they'll let them price it. They'll say, hey, here's the loan types. And if it's this, we'll pay you this. If you increase the prepayment penalty, we'll pay you this. So they have kind of this whole box of stuff that you can go out and price stuff. So it's a huge industry. And I mean, the lender, if you're a lender, it's kind of smart because you're like, I don't care, make a bunch of money. The higher you go is more money for us. But at the end of the day, again, from my perspective, people could debate about this all the time. I've had lots of discussions around it. I just don't see it as the best fiduciary way to approach things, because I kind of just look at it, if all things being neutral, then I'm like, well, then why the heck would I not always take the client to the place I'm going to make the most money? Even if it's not in their best interest. Now I could deceive myself and say, well, it definitely is, but probably not, So that's why we just stay away from it. Just helps me sleep better at night, just knowing that I'm not having to put my sales guys in those kind of situations where they're like, gosh, I could make 2 more points if I jack the interest rate up, So you should know about it, but we don't do it. So you might say, well, we don't want to work for you. Go work somewhere else, but it's okay. So swap rate, again, what's a swap rate?
I was kind of confused by this, so I wrote it down, but that's the rate of the fixed leg of a swap as determined by its particular market and the parties involved. Yeah, I didn't really understand this one very much.
Yeah, so a swap rate is well, I'll just put it this way, it's another index. Okay. So that's all you need to worry about for now, because it gets kind of complicated with swap rates. And again, it's kind of a type of instrument where there's a person who's doing the swap who's going to receive a certain dollar figure each month. And then there's somebody who's giving the swap who's going to be putting out a certain amount. And these are all just hedging instruments. And everybody's doing it based upon what they believe is going to happen to the interest rate environment. So if they think all of a sudden interest rates are going to go up, okay, then they're going to hedge themselves to say, well, I'll make money when it goes higher. Okay. And the other people say, well, I think it's going to go down. And I'm going to make money if it goes down. It's kind of like the option world of a put and a buy or a call option, right? Where you're kind of saying, well, I want to be in a position to put it to you in this certain situation where I might do a short sell, a short on something because I think it's going to go down. Okay. And so I'm just saying I'll make money. The worse it gets, the more money I'm going to make. Soros played this kind of game with the banks. Or you could do the option call where you say, well, I think it's going to go up. So I want the option to buy it at this price so that when it goes up, I can sell it here and I'll make a bunch of money, right? And so it's kind of this game of like, which way is the interest rate going to go? And then they'll create a swap index around it. And so again, it's just another index for you guys to kind of think about. Does that make sense?
Yeah.
Just kind of trying to explain the mechanism behind it, but ultimately the best thing you need to know is it's an index. And there'll be a whole training if you guys work here on swaps themselves. They get complicated. And it takes you a while to understand it. Then you're like, oh, okay, now I get it. But you guys might be smarter than I am and pick it up. Yield maintenance, defeasance, step down. What's it all about?
It's a prepayment penalty. So basically the lender doesn't want you to pay early because they lose out on the interest rate that would be charged against you for just paying later on. And there was I talked about like a step down method. It's like if you're so many years into your loan, maybe it's like 5% and then 4, 3, 2, 1.
Yes, correct. Yeah, so there's a step down of, if it's 5, 4, 3, 2, 1 or 10, whatever, it's 5% in the first year of the outstanding loan balance, 4% in the next year of the outstanding balance, and so on and so forth. If it's yield maintenance, did I walk you guys through? I think I did. Kind of this whole sort of scenario where, there's this fixed interest rate. And then all of a sudden, if the interest rates goes higher, it's beneficial to the lender. If it goes lower, then you pay the difference between the two, multiplied by the thing else. And did I walk you guys through that or not? Maybe not.
I don't think so. No, I don't think so.
So let me see. Just look at this real quick. See if I can pull this up here, because I think it'd be important for you guys to understand this concept more in depth. This might have been on the video too. Let me just see here. Hold on. Bear with me. Let me just look.
Help me understand the types of prepayment penalties. First off, a prepayment penalty is essentially a penalty for paying the loan off early. Many times.
So let's just kind of go back through this again, just so we can it's important to understand this concept. So I'm going to play it again, then we'll kind of explain it. Can you guys see that okay?
Yeah.
Help me understand the types of prepayment penalties. First off, a prepayment penalty is essentially a penalty for paying the loan off early. Many times, the lender doesn't want to be paid off, so they will penalize the borrower for doing so. Yield maintenance or defeasants are the heaviest prepayment penalties. The best way to describe it is as follows. Let's say that you have a $1 million loan. Your interest rate is 4%, and you have a 10-year term with a 25-year amortization. You close the loan and 5 years pass by. Someone contacts you and tells you they will pay a ridiculous price for your building. You say yes and want to pay the loan off. The lender will see there is 5 years left on the loan. They will then look at how much they could make by replacing that loan with a 5-year treasury bond. For the sake of discussion, let's say the 5-year treasury was 2%. The lender would calculate your penalty in the following way. They would take the difference between your initial rate, which was 4%, and what they can make with the 5-year treasury, which is 2%. So the net percentage amount you're responsible for is 2%. Let's also assume that after 5 years, your outstanding loan now is $600,000. The lender will take the 2% and multiply it by the $600,000. This amount would be $12,000. They would then realize there are 5 years remaining on the loan and then multiply the $12,000 by 5. This brings your total prepayment penalty to $60,000. Your response is probably, why the heck would anyone do this type of prepayment penalty? And the answer is because the rate they offer is typically much lower. You are paying to have a great rate. Now, let's transition to the next type of prepayment, which is a step-down prepayment penalty. These are much easier to navigate. A step-down prepayment penalty is generally a fixed percentage amount.
So does that make sense a little bit? So there's this idea that, you've got this rate that's fixed. The lender wants a make-whole provision. They want to make as much interest as they would have made in the whole life of the loan. This is why I call it make-whole provision loans. They want to make every interest dollar they would have made. So to do that, they put in this prepayment penalty that assures them that if the treasury market is still paying X, that's their index they use, and you're at Y, and it's lower for them, then just common sense is like, why would I let you pay me off and not, hit you for that? Because I'm going to have to replace the money with something a lot cheaper. So you're going to pay me the difference of what I would have made for the rest of the time, for the difference between what I can make in that situation. Conversely, if the treasuries are higher, then I'm like, who cares? Because I'm happy for you to pay me off, because I'll just make, more money with that money being replaced. Does that make sense?
So like in the case that the interest rates do go higher, are they still going to charge you an increased fee? Are you saying that?
Yeah, they will. Great question. They will still, the minimum they charge is 1%, no matter what. So if it's, higher to even a little degree, they're just going to say, look, you still have to pay us 1% to pay us off, which is still pretty cheap, a lot cheaper than what you would if it just keeps going lower and lower and lower. So you can kind of see, like, the bigger that gap, the bigger your prepay, the closer or further away from maturity, right? All those things kind of impact, what the ultimate penalty is. So now I just kind of, we designed all these videos, but that one, a lot of times I'll just send that to the client and I'll say, okay, let's talk about this after. And I'll explain it probably 3 or 4 times, because I've done this where I explain it 3 or 4 times. They go, yes, totally understand. And then they'll do it. Then they call me 7 years later, and they're pissed. What is the deal with this thing? And I'm like, dude, I explained this like 4 times. This is exactly why we went through this. Because I told you, if you're thinking about selling, don't do this loan. And they're like, oh, yeah, okay, I forgot. So they're like, holy crap, this is expensive. So we try to over explain this to clients. And I should say the ones that don't understand. If this is their first time doing it, I'm explaining it a bunch. If it's their 5th time, I don't, they're big boys. I don't need to explain it. Okay. Okay, good. So any questions about that? I don't want to rush it, but, also don't want to just keep hanging out.
So you said that when, like, in this original like loan, you don't like, not when they don't like reach out to you, and then you said that.
Like say that one more time, sorry.
So you set the fee in the original loan rather than like when they say, I want to pay it off early, then you set it?
Yeah, correct. It's already preset, meaning that, the rate is locked.
Okay.
And the index is already decided, but at the time they decide to sell or pay off, they have to go out and look at what the market is at the time. And then that market will dictate what the prepayment penalty is going to be.
Okay.
So that's why you're always kind of looking at what is your rate versus what is the treasury rate of the equivalent time that's left on the loan. That's how they're going to determine what index they use. If there's 7 years, they're going to look at the 7-year treasury. If there's 5 years left, they look at the 5-year treasury. Does that make sense?
Yeah.
Okay. Good question. Capital stack. What is a capital stack?
So it's basically like how much of the loan is from financing versus cash equity upfront. It's like how much is coming from the lender versus how much did you put in initially.
Correct. Yeah, it's basically you're kind of looking at it and saying, what is the stack of the whole thing? If it's 10 million bucks, how are you going to fund that? Is it 50% debt, 50% equity, 75% debt, 25% equity? The kind of, you have to sort of figure out what the stack is. Okay. So that's what we're talking about. Okay. It's just, there's a stack of money. How is it getting capitalized? It's really two ways, right? It's debt or equity. So not a whole lot there. Mezzanine financing.
Hybrid of debt and equity financing.
Well, not necessarily. It's kind of, it's sort of, I guess you could kind of think of it that way, but it is a debt instrument in a sense. It's not a second, although it looks like one. Yeah, go ahead.
Yeah, so like kind of like similar to a capital stack, like let's say like you get 75% from the lender and you're putting up 25% of cash equity, and you necessarily don't have that 25%. So you reach out to mezzanine financing to like, I don't know, like get like 10, 15%. That way you only have to put up 10 or 15%.
Correct. Yeah, it's exactly it. It's kind of again, capital stack. You're saying, okay, I got 75% of it in the bank. I'm supposed to come up with 25. I don't have 25, or I don't want to put in 25. So I'll get another 10, 15% from a mezz lender who will come in this sort of debenture position. What they're doing is they're taking a lien on the entity as opposed to the property, because a lot of the lenders don't allow for seconds. It's an event of default, so they don't allow you to put a second behind their first. And so that's how they came up with this kind of creative instrument, which is where they're doing is they're taking a lien interest on the entity itself. And what they're saying is if you ever default, then I'm going to just step in and kick you out of the entity and I'll just take over the deal and run it. So it's a little riskier because you could just totally lose your position. I suppose you could too if you're just getting foreclosed on, but there is a little bit more risk. And they sign what's called an Inter-Creditor Agreement, which is kind of the next thing. Do you remember what that Inter-Creditor Agreement was all about?
So if you have like multiple creditors like funding you money, is it like kind of a deal to like if it dissolves, who gets what assets and like why?
Yeah, exactly. It's just kind of this like you and me, if all of a sudden, I'm doing the first, Zach is the borrower, Ben is the one who's a mezzanine lender. You and I, Ben, have to agree on what are we going to do if there's an event of default, right? Who gets to do what, who's doing this, who's doing that. And it's kind of, we're pre-agreeing to all the things that will take place in the event of default. So that, you're not having to figure it out at the time, but you're preemptively determining what's going to happen in the event of default. Okay. Does that make sense? Okay, good. Loan to value, loan to cost.
Loan to value is just like the loan, obviously, and then the value of what the piece of real estate would be. So whatever that percentage is of the loan.
Yeah. Yeah, whatever the value is, you say, I'll lend you 75% of that value. And the lenders will say to you, they'll say, look, we're going to loan 75% of the value or the cost. Here's the key word, whichever is less. Okay. So if all of a sudden you're purchasing it for, 10 million bucks, and all of a sudden the appraisal comes in at 11 million bucks, then the response is that, do you think they're going to give you 75% of the 11?
Can you repeat that again?
So if they're doing $11 million and the purchase price is 10 and the value comes in at $11 million, are they going to give you 75% of the 11 or 75% of the 10?
Be 10.
That's right. 100%. They're giving you 75% of the 10. Because remember, they're saying whatever is less. Okay. Because the lender's not going to just keep giving you 75%. The purchase price is 10, and the value is 12 or 13 or 15. At some point, you're not putting any money in, right? So on purchases, that just doesn't make any sense. Okay. You with me?
Yeah.
So that's where we're at for today. It's 4 o'clock. I do want you guys to, I do want you to move on to the next section, which is the mining application. Okay. So I want you to go through that and get as far as you can. We are probably going to just finish off next time. I'm going to try to cram through the rest of this. But we are going to try to just keep moving on. I want you guys to move on to the mining application.
Do you want us to get the entire lesson 4 done?
No, I think just go as far as you can.
Okay.
So if you can get it all done, great. So these two sections kind of tend to move a little bit quicker, but I do spend more time in here than I do on the verbiage, just because there's a little bit more thinking that has to take place on why we do this the way we do it. So makes sense?
Okay.
Okay, guys, have a great weekend. Appreciate your hard work, and have a good one, okay?
Thank
Awesome.
you.
Thank you so much, Dave. Have a good one.